And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Bob Pisani, joined today by Nick Colas of Datatrek, Dave Nadig of ETF.com. Let's kick things off with the markets. The Dow and the S&P 500 having their best week of the year after rebounding. And that was a miserable May for the markets we saw here. We saw some big outflows last month. ETF investors withdrawing more than $11 billion. That's according to ETF.com. The biggest outflows were in U.S. equities, but international equities also saw outflows as well. These flows are rivaling the December 2018 and January 2016 outflows that we saw. Hey, one bright spot, the bond market. Overall, U.S. fixed income ETFs saw $6.2 billion in May in inflows. Just this week, bond flows saw the biggest inflows since February 2015. It's a lot to digest. What does it all mean? That's why we're here. Let's talk about this with some of the people who are here right now, Nick Colas and Dave Nadig. Dave, 1 month does not a trend make, okay? You and I have known this. We don't make broad conclusions. But one thing is for sure, the inflows into ETFs are still positive, but they're definitely slowing down a little bit. What do we make of this?
We're probably not going to have a record year for inflows, but look, we've seen this. Flows tend to follow overall market performance. And if nothing else, you could say the last 6 months have been choppy. You know, I think people are, lots of discussion about whether it's going up or down, but it's going to be choppy. Choppy tends to slow down flows, and we tend to see these moves out of things like, you know, large cap stocks in particular this time, and into safety plays like bonds, like total market funds. Long-term buy and hold investors are going for the whole market now.
Yeah, and Nick, the ETFs are used for strategic purposes as well. So you've got hedge funds out de-risking. You've mentioned this before as a very likely reason why we saw outflows from ETFs. It doesn't mean that the average retail investor is suddenly abandoning the stock market necessarily. Am I right?
That's right. If you look at the composition of those outflows last month, it was really three funds. It was SPY, S&P 500, it was XLF, which is the financial sector, and it was EEM, which is MSCI emerging markets. So that to me says it's more institutional investors perhaps using a little bit less ETF exposure causing those outflows. It wasn't just a mass redemption.
But on a broader sense, it's not surprising the industry is maturing a little bit, right? We were at 1 trillion, a few years ago. Now we're at 4 trillion. So is it a terrible surprise we're slowing down a little bit? Forget the crazy volatility and maybe hedge fund guys moving things around. The rate of inflows is going to slow naturally, right?
It absolutely will. Look, ETFs are still the preferred place for new money to go over, say, mutual funds, and has been that way for a while. But you're right. The pace of growth is slowing. Industry is getting more mature. And as Dave said, when you see some volatility, you will see some outflows now where 5 years ago you wouldn't have.
Yeah.
Right.
Bonds, though, continuing to get big inflows.
Yeah, absolutely. I think the bond market has effectively become the bond ETF market, and we've seen tons of research backing this up. Bond ETFs have become the price discovery vehicle for fixed income investors.
Yeah. And I want to go back to this maturation point about the market. Mutual funds have $19 trillion in assets under management.
Right.
The ETF business only has $4 trillion, and it's a lot lower cost that could probably satisfy the needs of a large part of that $19 trillion. Why am I wrong in thinking it should continue to siphon money off of the mutual fund business? Should it not? Am I wrong?
It absolutely will, but I don't think ETFs are going to get a strong foothold in 401k investments because of fractional shares, because dollar cost averaging when you're buying by the share like an ETF or a stock is very tough to do. So there's a natural place for both ETFs and mutual funds here, but like Nick said, new money, we're going to see it continue to go into ETFs.
And of course, remember, most people don't understand this, but when you trade ETFs, you don't normally trade the underlying shares. I don't know if you probably know the number, for example, with S&P 500 funds.
It's a very small fraction of ETF
well, you get a redemption or a
that
creation.
Actually shows up into it.
So the underlying shares don't trade, and most times when you trade an S&P 500 ETF, the underlying shares never trade.
Exactly.
Because they don't create or redeem.
Right. So when something like SPY, the largest S&P 500 fund, that could trade $100 billion on a day and maybe only see a $5 billion creation or redemption. That's a normal day for that ETF.
And this is one of the reasons, the old timers down here, they complain about the volume. So one of the reasons is you could trade these things all day long and they're not trading the underlying stocks. So what is ETF volume these days? 30% of the market?
Yeah, 25% of the market's pretty normal, and when it gets more volatile, that number goes up.
Yeah. What are you advising your clients? How do you're a master of data interpretation. Datatrek is one of the best firms out there, just looking at raw data and saying, here's what it really means. Does any of this bother you in any way? What does it mean?
No, it doesn't. We actually just did this work looking at fund flows, not just ETFs, but mutual funds as well, going back for the last 3 years. And we're nowhere near a kind of devastating sell-off kind of signal. This was natural market churn, as we've discussed. December had over $100 billion of outflows from mutual funds and ETFs. That was a real bottom. 2 years ago, January, had 100 billion inflows. That was a real top. We're not at neither point.
Great. Let's turn to the corporate bond market, because contrary to popular belief, recent reports from Bank of America and Jane Street Group saying that ETFs are boosting this space. We've been talking about this for a while. This makes some sense. So you look at thinly traded parts of the market, like high yield, okay? Got a lot of people coming in, buying it, and that's going to help stabilize it, as opposed to people who say, oh, ETFs are going to cause some massive, destruction of the market, and which we haven't seen yet. But just wait, they say, if there's stress in the market. Well, we have stress in the market. What was December? We were biting our nails off down here.
Yeah, I mean, I do think that, like I said, I think that fixed income ETFs have become the fixed income market. That's where we see a ton of the activity now. And they've given access to things like high yield or junk bond munis that were very difficult to get except in specialized, generally overpriced mutual funds. I mean, do you think that the corporate bond market's fundamentally different now than it was 10 years ago?
No, and frankly, given the increase in the size of the corporate bond market, corporate bonds are now 50% of GDP. They've never been that high before in history. You do need new sources of liquidity, new sources of demand to fund that.
Yeah, and remember something too. When you're dealing out there with these bond markets, when you get redemptions with bonds, you have to sell the bonds, obviously, right? But that's the same with here. It's not necessarily the case, though, necessarily with bond ETFs.
Well, a lot of bond ETFs will do creations and redemptions in cash instead of in kind. So there can be a difference there. But fundamentally, markets are markets, and if everybody wants to sell, prices are going to come down, and that will get transmitted into the underlying bonds.
Yeah. So is this less so for more liquid investments? I mean, it doesn't matter that it matters less, say, with investment-grade corporate bonds. I'm just trying to think of something that's really big.
Or treasuries.
Or something like that. It would matter a little bit less, right?
Yes, exactly. Those are already liquid markets with a lot of price discovery. But to your point, if you have a volatile bond market and it begins to hit ETFs, ETFs will just price to a discount to NAV rather than force the ETF to blow out the positions. Unlike a mutual fund where you get big mutual fund redemptions, the PM has to sell those positions.
Okay, let's move on here, because I want to get to something that baffles me, and the man here is an expert, is going to explain it to me. I want to turn to one industry that's streaming higher: gaming, esports, also known as electronic sports, projected to become $1 billion industry this year, and you guessed it, there's an ETF for that. In fact, there's two of them. Investors looking to get their game on in the esports hype have two exchange-traded funds to do so. The Van Eck Video Gaming and Esports ETF, the symbol here is ESPO. That's a market cap weighted index of companies involved in the gaming and the esports world. And just this week, the Nerd ETF, yes, NERD, also launched on the New York Stock Exchange. Its holdings include game publishers, streaming network operators, and hardware companies involved heavily in that space. Ed Lopez is the head of ETF product development at Van Eck and one of the masterminds behind this. Can you explain to me, I understand that people like to do gaming. I get that. Gaming's a bigger business than the movie business today. But watching people play games is a bit like a mind stretch to me, and yet the business is huge. How do you explain that?
That's amazing to me, too. And that's one of the reasons why when we looked into it, we decided to launch this thing. There's a lot going on in the video game space. But to your question, I think it's a little bit like traditional sports. If you play traditional sports, you like to see other people play it at a really high level. Today, it's a new generation with technology that's really facilitated online gaming, interactive content, and new outlets for entertainment for a younger generation that play games, and now they have the opportunity to see people play games at a very high level.
Yeah.
And I think that's one reason why you're seeing this kind of.
So you went to a big game at, was it Madison Square Garden?
Madison Square Garden. I went to the League of Legends finals here a year or two ago with my son, and I have to tell you, it was one of the best sporting events I've ever been to. People are excited because this is a game they play.
Yeah.
And like Ed said, they get to see the pros play it. I'm not going to go play football at the age of 52, but I can play this game and then understand.
So it has to do with how heavily invested you are in that. If you're really into basketball, you're going to get excited. If you're really into
League of Legends,
you're going to get excited about it.
Or any of these games.
Will people watch anything at this point? There are babies that are opening presents that are millionaires on the internet now. I mean, I don't know what it means overall. How's the fund doing? How did you create it?
Yeah,
you
we launched it late last
year.
It's 24 million right now. We had to go through the last quarter of 2018 with some of the tech stock stuff. Great attention. We've had some inflows in, so it's doing well right now.
I noticed it's a pretty concentrated portfolio. You have Nvidia 7%, Nintendo 7%, Tencent, that's the Chinese gaming company. That makes sense. 7%, 60% are just 10 companies.
Yeah.
There's not a lot to buy, right? I guess.
Well, there's a universe there, and I think the key with the thematic ETF is trying to get pure play exposure. So for Van Eck, what we try to do is identify those companies that are earning a majority of their revenue from that space, and then providing a nice liquid structure for that too. So there's a couple aspects to introducing a thematic ETF. One is not only the pure exposure, but making sure you have something that can scale, that can provide a nice trading experience for people, so with tighter spreads. So you want larger companies, you want liquid companies, you want pure companies.
The video game industry surpassed the movie industry in revenues several years ago, and now I see, some research we did for this, esports will raise over $1 billion in revenue this year. Esports, just people watching the video games, will raise $1 billion.
It's people watching, it's people, companies paying for media rights, advertising, video game publishers paying sponsorships to streamers. There's a whole new ecosystem.
So where does augmented reality play in here? Have you any sense that the whole augmented reality and virtual reality thing has sort of held back the last few years because the promise is not kept up with the reality, I think. But that seems like tremendous potential.
I would think so.
If you could put yourself in a dungeon with a machine gun, and it's like we're sitting here, and I'd kill you immediately, by the way, Dave. But that would be exciting. I'm just trying to get you excited over this.
I don't think VR is quite where it needs to be right now.
Yeah.
Maybe in time. I think one of the next steps for the industry is going towards mobile and going towards cloud gaming.
Yep.
Yeah. That makes sense?
Yeah, it totally makes sense, and I do think that this is a very fast-moving space. It's not surprising that the two funds here are very concentrated. Different approaches, slightly different portfolios, both of them actually giving you that pure play exposure, though, and that's generally the hardest thing. I've been on the show talking about some of these funds that I just don't think get it done. I think these deliver the pure play exposure.
Tell me you're a hidden League of Warriors, gamer or something like that, Nick.
I've got nothing on that count, but I do respect this as a global phenomenon. This isn't just in the U.S. It's even more important in China.
Yeah.
Hence the 10% exposure. It's a global phenomenon, and it's just going to continue to grow. Moore's Law will double computing power every 2 years for the next 10 years. Imagine the games you'll play in 10 years' time. We'll all be able to not just go to an esports event, but to perhaps be in the game with the champion.
Yeah, and yet the assets under management are still pretty modest.
They're still pretty small, still a young ETF.
Yeah.
But I think there's still a lot of potential for the space. I think one thing a lot of people don't recognize or appreciate about the video gaming space today, esports is the tip of the spear. Video gaming is a $140 billion business. And what's happening is it's providing a venue for people to find that interactive online content, a place to hang out. It is, I think, going to help transform video gaming. So it's not just about buying video games. It's about an entertainment experience.
Yeah.
You have professional sports buying esports teams. It's going to be a big industry.
Thank you for enlightening me. And you too. Nick, you're with me. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Dave Nadig, my dear friend, and Nick Colas, also my friend, for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. You don't have to wait a whole week to see us again because we're back Monday at 1 p.m. We're that popular. Have a good weekend, everybody.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.